My last year of business school, I took an advanced valuations course where we had a project to build a DCF for any company that we wanted. This was literally the most stacked team that I'd ever been on. The second year MBA on the project was the current technical lead of the investment banking group. I was the incoming technical lead for the investment banking group. And the other 2 or 3 folks on the team were all going into tech banking at top elite boutiques and bulge brackets. So we picked the hottest company at the time, which was NVIDIA. We both broke out the revenue streams, gaming, data centers, automotive, and we asked one question: what would have to happen to those revenue streams to justify the current share price of that business? The answer was totally absurd. Data center revenue alone would have to continue multiplying for nearly a decade. That's not growing on a percentage basis, literally multiplying year over year. Once you start to actually look at those numbers, you realize how ridiculous it is. Like, you're starting to ask physics questions, like, is there going to be enough energy produced or concrete available to actually build all this? And based on that fundamental logic, we could not justify the current share price, and we advised in the report to sell. And then NVIDIA just kept going up and up and up. And despite our solid technicals and fundamentals, we just looked a little foolish. So here's what's interesting, though, about a technology business like NVIDIA. If you looked at NVIDIA 10 years ago, there's no way that you could have just projected out all of the growth that has happened in that business. It's one of the reasons why I love technology companies, because you never know what they're going to do next. And in fact, NVIDIA became a dominant player in a market which didn't exist really 10 years ago. But it's still important for us to build these types of discounted cash flow models anyway, just to see what revenue would have to be to justify the price. Quick introduction for anyone new. I'm Michael Neal. I'm the founder of OFFERGOBLIN. I'm ex-Centerview, ex-UChicago, MBA and Masters in Computer Science. I'm also one of the top-rated coaches and experts on Leland. This is a part of a technical series meant to build your intuition around investment banking technicals so that you can succeed in interviews. Today is about the discounted cash flow model, and by the end, you'll have an intuitive understanding of what goes into it, what it means, how it's built, and where it breaks. There's a ton of related links below with real investment banking interview questions and a completely free guide to the DCF. You should like this video and subscribe to this channel for more. All right, now let's get into it. All right, so really quickly, I'll give you an overview of the DCF that you can use for your investment banking interview. So there's 2 periods to a DCF. In the first period, it's usually going to be 5 to 10 years, and it represents revenue stability. So if it takes 5 years for revenue to reach its sort of peak and plateau, we would use a 5-year period. For some businesses, it can be a bit longer. In each of those periods, we're going to be looking at revenue down to free cash flow. We project those out for each year, and when we reach the end of that period, we reach period 2. That's when we're going to be looking at a terminal value, which is essentially what the business would be worth if we sold it at that period of time. We're going to take all of those points of value in time and discount them back to the present value using a discount rate. That's to represent the time value of money. And out of all of that, we receive the value of the business. It's the present value of these future cash flows and terminal value. So now we'll get a little bit deeper into why we do all of this and what those components actually are and mean. So for the last 2 videos, we focused on pricing a business, and we used relative valuation methods, which means we're comparing our business to other businesses. So we can say, well, our business is similar to this one and their shares trade at this multiple, so we would expect our business to be around there. Or this business last year sold, which is very similar to our business. How do we compare against that one? Now we have a more interesting way of valuing a business. And that's, instead of considering what the business would be sold for, we asked, what will this business actually produce in terms of cash flow? This wouldn't be a real DCF video if we didn't shout out Aswath Damodaran. He's a professor at NYU in the finance world. We'll call him the Dean of Valuation. He pioneered a huge amount of how this model gets used and spent decades answering the edge cases that no one else wanted to, like how to value a business that makes no money, or how to value a business in a country that's failing. And he publishes a lot of that online for free. If you end up going deeper into valuations later, you'll probably run into that name. And there's one really important thing that OSWA tells us, and that is that price is what someone will pay for a business. Value is what the cash that business produces is actually worth. And these are usually two different numbers. And it's the entire reason that intrinsic valuation methods exist. Comps will teach you what the market thinks this business is worth. A DCF helps you derive that worth, so you can try to understand from first principles what the value of the business actually would be. It lays it out in a way that allows us to explicitly state our assumptions and show our work in doing that. And by doing all of that, we develop a better understanding of the true value of the business. All right, so let's start out by talking about period one of the DCF. The first thing that we're going to need to decide is how far out we're willing to guess. Remember, we're going to build an explicit forecast year by year of the cash flows for a certain period. The standard is usually going to be 5, but it can often be much longer if we expect the growth of revenue to take a while to plateau. And one really interesting case is in a mining business where there's a fixed amount of resources. You really don't need to forecast an explicit period. You can forecast the entire period and model out the entirety of collecting all the resources from that piece of land and then selling it. In that type of business, there's just a lot more clarity on the value that you'll be able to mine. But for other businesses, we're going to pick a period where we believe it will reach stability. And that means growth settling down. Margins and reinvestments stop moving so much year to year. And the business has become a mature, cash-producing company. So for those risky tech businesses that we talked about, let's say the ones that are losing a lot of money today, we might use a 10-year period because it may take some time for them to be able to get out of the red. If you look up a business like Uber, for many, many years, they were working on a negative cash flow. So in order to get a real valuation of this business, we'd have to push that forecast all the way forward into not only making a lot of money, but also stabilizing the growth. So there's a little bit of art in this. Oftentimes in an interview, you can pick a 5-year period and it's defensible because it's the standard. In fact, if you're pressed, I would pick that and just explain that you believe that 5 years would be the period that it would take for this business's revenue to reach maturity. But use your best judgment and understand why that period exists. Okay, staying in period 1, let's go a little bit deeper into the cash flow of a single year. So remember, profit is an opinion. We're looking to derive the actual cash flow that this business produces from its operations. We're going to build free cash flow in 5 moves. We're going to start at EBIT, that's operating profit, earnings before interest and tax. We're going to tax that number directly, pretending that it doesn't have any debt or interests. So subtract taxes. We're going to add back amortization and depreciation because it reduced our EBIT, but it's not an actual cash number. And then we're going to subtract capital expenditures because that's real cash going out the door for real assets. And finally, we're going to subtract increases in working capital because growth often ties up cash in inventory and customers that haven't paid out yet and other sort of in-between accounting details. So we're going to take that same 5-step build and we're going to take that into each year, year 1, year 2, year 3. And now we have a row of free cash flow for each year. One common mistake that people make when deriving free cash flow for a DCF is that they take the tax number off of the financial statements. The problem with that is that that tax number accounts for debt tax shields, which we're actually going to account for later. But if you count it here, you've ended up making the company more valuable than it actually is. So here's an investment banking interview question that can trip you up about DCFs, and it's asked by Moelis. They ask, what types of cash flows do you use for a DCF and how do you get there? Well, you're going to use unlevered free cash flow. The reason is that you're trying to account for the value to all shareholders. Remember that a DCF is going to derive us enterprise value. And the way that we get there is those 5 steps that we mentioned. EBIT, operating profit. We're going to subtract the taxes. We're going to add back depreciation and amortization. We're going to subtract CapEx and then subtract increases in working capital. If you're able to do that and explain that, then you have a very good grasp of the first period of a DCF. Okay, period 2 of a DCF. You've reached the end of your first period. You have a column representing each year, but the company intends to exist forever. which we'll call the going concern, here's how bankers will close the gap about that continual future state. The entirety of period 2 is going to be represented by one single number that we're going to call the terminal value. What it is technically is 1 year beyond period 1. So let's say 5 years, it's going to be the 6th year. It's going to be all future value of the business discounted to that 6th year, all future cash flows discounted to that 6th year. And there are two ways that we can calculate it. The first way is the multiple method. You're going to take, let's say, EBITDA in your last year of your period 1 and apply a multiple to it based on your peer set. And what this represents is essentially the exit value of the business. If we were to sell the business at that period, how much would it be worth based on the growth of these other financial metrics into that period of time? The second is to represent perpetual growth using the Gordon growth method. This assumes essentially that cash grows at a fixed small rate forever. And this one formula represents that infinite stream. It's a little more academic, but it can show up in steady businesses like utilities. Here's something that people often screw up about terminal value in investment banking interviews, and that is making the perpetual growth rate too high. The reason that's a problem is that the economy only grows at, let's say, 2 or 3% per year. If this business is even slightly above that, then it would essentially grow out of control and become bigger than the entire economy. So when you're choosing a growth rate, you're using the Gordon growth method, that number needs to be really 3% or less. But the main thing is that you pick a defensible range and that you're sanity checking it. Because ultimately, all of this is in order to try to decrease the amount of uncertainty about the actual value of a business in a structured way. One last thing to note about terminal value is that it usually represents 60 to 80% of the value of a business, which means that most of what a company is worth sits in the years that you never forecast. But you'll spend a week on period 1 and sometimes 30 seconds on the terminal value. So when we're going to discount both of these values, period 1, period 2, back to present day, we're going to use a discount rate, and that's what's called the weighted average cost of capital, or WACC. The reason that the WACC exists is because $1 tomorrow is worth less than $1 today. There's two main reasons for that. The first one is that we could have used that money for something else, maybe another investment or just getting a better haircut or paintings on your wall. And the second reason is that there's a little bit less certainty about $1 that you're going to pay me tomorrow. A lot of things could happen between now and then. So future dollars are valued less, and even less the further away that they are. The way that the WACC, or the discount rate, is determined in a DCF model is by looking at who is funding the business. The WACC is a way for us to understand how much return those investors expect for their risked capital. And there's two main groups of them. The first is lenders or debt holders. Debt is a little bit cheaper to fund a business, partially because they have a little bit less risk. They'll be the ones getting paid out first. And on top of that, there's a tax shield on our interest payments. So indirectly, the government is helping to run and pay for our business. On the other side are shareholders. Shareholders are a little more expensive because their risk is much higher. If something goes wrong with the business, their investment could go to zero. So here's what you need to know about WACC for an investment banking interview. First, WACC blends the cost of debt and equity. Second, the cost of debt gets multiplied by 1 minus the tax rate. 3, the cost of equity comes from CAPM. Here's the best way to verbally say the formula for the weighted average cost of capital. First, we're going to take the total amount of debt. We're going to multiply it by the cost of that debt times 1 minus the tax rate. Then we're going to add the total amount of equity times the cost of equity. Then we're going to divide that whole thing by the total amount of debt plus the total amount of equity, and that gives us the weighted average cost of capital. One follow-up that you'll get about the weighted average cost of capital is why do we include that 1 minus tax rate term? And what that represents is the tax shield, because interest payments on debt is deductible. Another common question, how do we arrive at the cost of debt? That's going to be the average interest rate that we pay across all of our debt. How do we arrive at the cost of equity? For that, we're going to use the CAPM formula. Here's what you need to know about CAPM for an investment banking interview. First of all, it stands for the Capital Asset Pricing Model. You use it to find the cost of equity. The formula is short. Cost of equity equals the risk-free rate plus beta times the equity risk premium. 3 pieces. Let's start with the risk-free rate. That's what you'd earn on a 10-year U.S. Treasury note, which pays you a fixed rate every 6 months. And after 10 years, you get your principal back. It's about as safe as an investment as you could possibly get, and that's why it's called the risk-free rate. Next is beta. Beta is how hard the company moves compared to the market. A beta of 1 moves perfectly with the market. A beta of 2 would swing twice as hard, but in the same direction, and a beta of -1 would move in the exact opposite direction. Last is the equity risk premium. That's the extra return investors want for owning stock at all, and it has its own formula. It's basically the expected return of the S&P 500 minus the risk-free rate. The S&P 500 representing broadly public market performance. What's really important is that you understand the intuition behind this. CAPM is really about opportunity cost. It's what the money could be earning elsewhere today. An investor looking at your company has to consider what else that dollar could buy them. So the cost of equity is what they expect in terms of return, because that's what they had to give up to be here. So that is the WACC, the discount rate. You're going to use that discount rate to bring that terminal value and all of those values in phase 1 back to present value. In practice, when you build these types of models, you're going to build sensitivity analysis into them to represent ranges of assumptions that you're making. Ultimately, this is entirely about being very structured and diligent in the way that you're creating this so that someone can look at your work, understand your assumptions, maybe tweak them a little bit, and recognize that what you're doing is the best guess at intrinsic value. Because ultimately, you're creating a document that's just meant to communicate something and support your definition of what this business is worth. Now, after all of that, we've arrived at this enterprise value. Once we've discounted everything, we've arrived at this single number. There's other places that we can take it. For example, we could subtract out the current debt that the business has to get to equity value. Now, I know that there's other claims on the business that we would subtract out as well, but broadly, that's the way that we can think about it. So this is meant to be sort of an intuitive overview of the discounted cash flow. You'll spend your career working in these types of models, so consider this to just be sort of your entry point. I'm sure you'll have questions. Feel free to ask them in the comments. You can reach out to me. There's a bunch of ways to connect, social media, all these other things in the description. There's also a bunch of practice problems you should take a look at. And as always, like and subscribe if you'd like to see more of this kind of content. It really helps our channel grow. Thank you very much. We'll see you next week.